All right. Well, it's 9:35 here in Denver, and we are going to get this deep dive kicked off. Again, if those of you have joined late or just joined rather, we will be recording this, and so we'll get all this out along with materials. And as my favorite podcaster Tim Ferriss says, all the show notes we'll send to all you guys, and make sure you have all the information you need at your fingertips. So. I looked at the list of registrants prior just last night. We got a good crew on board, and so thanks all for attending. I know most of you, so good to see, or verbally or not verbally. Good to not even visually see you because you're all hiding yourselves behind whatever bad hair days and driving and wherever else. But there's Brooks. See, coming in strong. Good to see you, Brooks. So thanks for joining us. We're really happy to be here and to be doing this. And I want to take just a quick minute before I start sharing my screen and all the materials to introduce our esteemed panel. We got Frank Hirsch, who's with WealthPoint in Chicago. Travis, who is with, well, it used to be Lombard. Now, I'm going to screw it up. What's the new name?
Axcelus.
Axcelus. So Lombard International is now Axcelus. And then Anthony Stanek down to my lower left over here, down in Phoenix, with Investors Preferred. So I'm going to share my screen. We're going to do some quick, let them share a little bit about themselves to each of you. And then we're going to get into deep dive number one, repurposing existing life insurance for PPLI. So let's see if this can, all right. Quick check on that. Frank, is that showing the full screen?
You got it.
Awesome. Awesome. So real quick conversation. Are you handling this, Frank?
Yeah, sure.
Good.
So this is our agenda for today's deep dive, repurposing traditional life insurance. And we're going to go through 3 different case studies. One where the existing traditional life insurance is already part of the plan, using PPLI to offset premiums for traditional life insurance, and then an underwriting outlier where we use traditional life insurance as part of the PPLI program. As Ben said, we're going to attempt to make this as interactive as possible. So feel free to jump in at any time with any question you have, okay? And just a quick reminder. So we are talking about repurposing existing life insurance. So this is not your PPLI 101. If you do have questions just about the basics of PPLI, you can either reach out to Ben or me directly, or go to our website, or scan the QR code in front of you.
Yeah. So before we get into this whole idea of repurposed PPLI, I want to take a quick minute and let Travis and Anthony talk a little bit about their backgrounds, their positions at their current companies, and a little bit more about themselves. So Travis, why don't you jump in and start it for us?
Sure. Thanks, Ben. And thanks everybody for joining us today. So I'm a managing director at Axcelus Financial, formerly Lombard International, US and Bermuda. I do a lot of our cross-border planning and offshore work, as well as I'm responsible for everything Catalyst, which is our repurposed product that we use here. And I'll just throw out there, one question that I get a lot is, is this new? It seems new. How much have you done? Those types of things. And, Ben and Frank have been great supporters, but as of end of 2023, we had about a little over $500 of assets under administration in this product, and we have about a little over 400 million of recurring revenue and a pretty significant pipeline. So we've been doing this for the last 5 years. It's been very successful, and I think this is a great meeting to dive deep into it.
And Travis, I remember hearing about this product. I want to say 10 years ago. How long have you guys actually had the product?
We launched in 2019, but this isn't a new idea. I mean,
okay.
Carriers have been repurposing, as you know, Ben. I mean, and Frank, traditional life insurance for the past 20 years. So, I mean, this isn't a new concept by any means.
Got it. Anthony?
Yeah, I appreciate it, Ben. So my Anthony Stanek, and head of business development here at Investors Preferred. So a US-based domestic private placement carrier that just does private placement, life insurance, and private placement variable annuity. And as Travis had mentioned, pretty significant opportunities. We always like to say we're always kind of looking for a three-legged stool, when it comes to private placement, the life insurance carrier, the insurance professional, and then the wealth management professional that's managing the money. So what you'll see in these three case studies, just an example of clients that have already done potential planning, whether it's estate planning or legacy planning, and what a great way to potentially wrap some of these assets that are, high returning assets, but just not very tax efficient. So it's a very interesting way to do that. And so the name of our product here at Investors Preferred is our private mortality coverage. It's been around since 2018 that we've been had that on the platform as an option. So look forward to it.
Awesome. And, here at WealthPoint, we've used both products. We like them both equally well, honestly. Like we're agnostic on carrier on that deal. We just want to be able to provide our clients with options and again, go with the product and circumstance that best fits the situation. So with that, let's jump right into the question at hand. So this is one of these things, again, I heard about this, even if there wasn't a product. I remember sitting down with the Lombard folks many years ago, them telling me about this, and it just kind of blowing my mind. Like, wait, you're going to take existing life insurance and you're going to somehow make it into PPLI. I've been in the insurance business now 22 years, 23 years. And, felt like I was pretty smart in the insurance world. I could not wrap my head around it. And I'm a little slower than most too. A lot of you guys know that. Brooks is smiling because she knows. I'm from Arkansas. Yeah, it takes a few minutes to get through this skull of mine. But in the last couple of years, we've kind of figured out, one, the way to tell the story, and two, the right applications for this product. And we've seen some success. We placed a couple of really significant cases last year with both firms. And this is why we wanted to host this webinar, was to tell all of you about it so you can kind of be on the lookout for useful fact patterns. So the way we want to describe repurposed PPLI is to talk about what is PPLI to begin with. This is the way I would explain it to a client or anyone else. And when you think about PPLI or any insurance, but really PPLI, a carrier is going to issue an insurance policy that really contains two components. You've got the life insurance death benefit, right, which is the big number that everybody sees. But underneath that death benefit, if you want to think of it like that, kind of under the umbrella of the death benefit is this investment account, right? It's the cash value, as most people would know it. And again, what's cool about PPLI is that professional asset managers can manage this underlying cash value. Ultimately, the idea is this cash value grows, it pushes up the death benefit, and then when the client dies, it pays out a tax-free death benefit that's inclusive of this account value, right? And so it looks like a combined product, but there's really kind of two elements at play. So if I've got an existing life insurance policy, and it may have those two elements already, but I don't have the professional asset management, there's a way to combine those two. We can do that. And so this next slide kind of explains what we try to do very simply is explain how does that work. All right. And so on the left-hand side, what you're going to see is a couple. It could be a trust. It could be whatever. Again, whoever owns this insurance policy. Let's say they have an existing life insurance policy. If they want, they can assign the death benefit to a PPLI carrier, right? They're going to assign it to Travis or Anthony, and then basically think of it as making a big U-turn. The PPLI carrier is going to simultaneously reissue a new PPLI policy for the amount of the death benefit they were just given or assigned, plus this tax-deferred investment account underneath it. So the client's never losing control of the asset in the sense of the amount of death benefit that they actually want and need for their planning. But what they're able to get is they're able to tuck under or tuck into the existing planning this additional tax-deferred investment account. One real simple way I like to talk about it, and I'll pick on Frank because we're partners and we've done this before. But if I said, hey, Frank, will you write me a $100 life insurance policy? Frank would say, sure, I can do that. He has plenty of cash reserves. If I die, he can write my wife a $100 policy. But if I said, hey, Frank, will you write me a $10 million life insurance policy? Frank has those assets, but he probably doesn't want to spend money if I die suddenly, right, driving home from work tonight, right? But if I say, hey, Frank, I'm going to assign you my $10 million term life insurance policy, will you now give me a $10 million policy? Of course he can do that, right? Because he's being backstopped by an existing product with a guaranteed death benefit, right? Now, Frank's not a carrier, and forget all the regulation stuff that you have to go through to do that. But the idea is the same here. Axcelus and IPL can issue our clients new insurance without underwriting, right? Without going through the exam process and all that stuff. If they get assigned death benefit, think of that as kind of they're getting reinsurance. So before I go on, that's how I explain it. Frank, would you add anything to that? And then I'll let Travis and Anthony chime in.
Yeah, so I think, you know, one thing, and Travis and Anthony, you guys can comment on it. Maybe in terms of, does it matter that the client is still paying premiums on their traditional insurance, or does this have to be policies that they've already completed their payments? That would be one initial question.
Yeah, I mean, that's a great question, Frank. I mean, we see it both ways. I mean, obviously, if it's a paid up policy, that works great. But if they're paying premiums, you know, what I always like to tell people is you have this host policy that you're already paying the cost of insurance charges on. And now you can use that cost of insurance charges dual purpose to turn around and issue a brand new PPLI policy with no new cost of insurance charges and no medical underwriting.
Right.
So I think being able to use one policy to meet two different needs potentially with one overall cost of insurance charge is just a very efficient, you know, access these types of solutions.
And just to back up what kind of Travis had mentioned, I think the biggest thing when we talk about PPLI, you know, it's kind of the holy grail from the taxation standpoint in private placement, right? You have private placement annuity, which is more of a deferral. The benefit of PPLI is that tax advantage growth and potentially access to it and the tax-free death benefit. So when taking a look, it kind of removes any objection from a cost of insurance standpoint, especially if a client is already paying that, right? So it kind of removes it. What it also removes is potential underwriting issues that I know Ben's going to touch on later here. But if you have a client that has done some of this planning already, potentially gifted money outside to an ILET, but still has other assets in there as well, well, now it's something that can be repurposed and used in that fashion, right? So it really opens up opportunities for somebody that's already paying or somebody that's potentially uninsurable, where PPLI would be not part of the conversation any longer.
And one last question, because Ben mentioned in his opening, he referenced a guaranteed policy. The client can use a guaranteed policy, right, Anthony? Or it could just be a traditional UL policy too, right?
Yeah, usually we look to make sure, because the goal is to make sure that we have death benefit that's going to remain. So we're always going to take a look at the health of the policy. Same that you guys would be doing in like a policy review, so an in-force illustration. It's how it's being used. Potentially as well in the first 10 years. With a 7-pay test that's there, maybe it's a combination of even term and permanent coverage as well, right? Because we always kind of looking to solve for the lowest amount of death benefit for the maximum, bang for CLI costs that we're putting in these structures. So that's the nice part, is you kind of just take a look at the policies that are there, reach out to either one of us to kind of review what can be used in the structure and what cannot.
So Travis, what are, understanding that we're taking existing life insurance, and our very first case study is going to look at this. A client bought a survivorship policy for estate planning. They needed the liquidity, so they need to keep the policy, right? And we're going to repurpose that to add PPLI benefit. But and as long as you've been doing this, what are the most common use cases? What do the clients look like? What's their net worths? What ages are they? That kind of stuff.
Yeah, that's a great question. So, with PPLI, we typically see the younger ages, 40s, 50s, maybe into some 60s. With the repurposing, we're seeing more older clients, 60s, 70s, even 80s, we'll issue up to age 90. And it seems to be more of a estate planning sale. Again, I just looked at the numbers. Our average host policy face amount is about $30 million. So that's kind of what our average case that we're repurposing. And I think the most productive and biggest opportunities I see are, a client has, $50 million of life insurance in a dynasty trust or some sort of irrevocable trust that they've already, gifted outside of their estate. And then they also may have investment assets in that estate or in that trust. And as everybody knows on this call, I'm sure trusts aren't overly tax efficient, whether grantor or non-grantor.
Right.
And what we can do essentially is kind of marry the two and back into that and say, okay, you have this $50 million policy. If we issued a new private placement policy under this genre, how much of those investment assets could we move over into a new PPLI policy without the underwriting and shelter from, the tax drag? And oh, by the way, that also creates sort of a synthetic step up in cost basis inside those trust structures, which is another value add to repurposing those assets from being taxable investment assets into, life insurance. So I think that's probably the biggest sale that we see in the most efficient.
Yeah. So there's really no, or maybe I should ask it a different way. I mean, my perspective, there's no drawback to doing this. There's only benefit, right? I mean, there's very, very low lift on the client's part, right? No underwriting. You had a new application, but they don't have to go get examined or anything like that. But I don't see any really negative. I mean, we get to avoid taxes on a big slug of their, investable assets in a trust, right? Is there any downside that you can see?
It's interesting because I get asked the downside a lot because, as you mentioned, there's not a lot. And so what I would just say is the friction is just the initial setup, of understanding it, doing the paperwork, kind of, getting all the docs as Anthony mentioned from the, other carrier to look at the enforce and all those, getting a copy of the policy. But other than that, I mean, if clients have existing policies and are looking to utilize PPLI, I mean, anytime I talk to somebody that is looking at potentially doing PPLI, the first thing I ask them now is, do you have existing enforced coverage that we could potentially dual purpose that asset? And it just makes a lot of sense.
Yeah. One quick question for both of you guys before we move on to the case study, because I know this is kind of where it'll start to crystallize for everybody on the call. I know we want the policies to last, right? Obviously, if the underlying policy lapses, right, the whole thing collapses, right? Because now, either carrier doesn't have that backstop that they were previously provided. So the whole thing unwinds and you got a big tax problem. But I know, Travis, you and I talked about doing Catalyst on a term policy that has sufficient duration. Can you talk about that for a minute? And Anthony, you and I haven't talked about that, but is that something IPL would consider as well?
Yeah, sure. So we'll take any policy type. I prefer not to take term, but I will take it like we did for you, Ben. If it's got a longer duration, I don't want a term that's going to lapse in 2 years.
Right.
I mean, the stance that I have here is that we want the clients and the advisors and everybody else to understand that the host policy is backing this new PPLI policy. So it's acting as the host. So anything that happens to that host policy will directly affect the new PPLI policy. And so I'm comfortable taking policies that might only run to age 85 or age 90 or not run all the way out, simply because you just communicate to the client and the client's advisors up front that, the impact of mixing the two together. For example, we had a client that we did a big transaction for, and she's now 87. The host policies are only running to age 90. And so what the advisors are doing is just taking some money from the Catalyst policy, taking some of that basis out tax-free, right? And shoring up the host policy. So, so I think, and you've done some of that too, Ben and Frank. So I think there's a lot of flexibility if you really understand these and work with somebody like you and Frank that understand all the moving parts and how you can really, put this in place, but also change it as the plan changes for the benefit of the clients.
Yeah, that's a really good point. And that kind of almost marries the two, Travis, the existing insurance plus kind of new insurance. I mean, Catalyst might be a way to shore up a policy that's needed for estate planning, but the client may not have the cash flow to, keep the premiums going. Functionally, you can use the tax savings from that PPLI policy to offset some of that additional cost that they otherwise wouldn't want to cover.
No, I agree. I mean, I think that's the most interesting thing about this.
For sure.
These types of solutions is that it's not one fits all, right? It's looking at the client's specific situation, which you guys do great over at WealthPoint, and figuring out, where we can really get the maximum benefit for that particular client situation. I think you guys have done a great job with that. We can't talk about all the cases you've done because you've done all sorts of different cases that have all different parameters than what I mentioned. But it's very unique.
Anthony, anything you'd add in terms of the host policy, the underlying policy, duration, term, stuff like that?
Yeah, absolutely. I think the biggest thing is, you won't see, if you're to take a look at Investors Preferred site, you won't even really see that much information with the PMC, and that's kind of purposely done. Is we usually will not interact with somebody that doesn't have, a high-end insurance professional, because this is what you guys do all day long, right? You're reviewing retail policies, how in-force illustrations work, how underwriting works. So that's a large part of it. To Travis's point, probably the largest issue and the biggest lift is just the idea of the structure itself, what can go in it, how it works, and then the maintenance of the policy going forward. That's probably the biggest thing, and really the only downside to it is you just have to have somebody to manage it on the front end and then on the back end as well. So we're fairly picky with the type of agents that we'll reach out to with this idea for that exact reason, right? Is it's not commonplace. It does take a little bit higher level of understanding, but when you get it and it works well, it's extremely powerful.
And Ben, I'll just add on to that real quick, because I think, you asked about why wouldn't you do this? I think one of the other key components is, as you well know, and Anthony knows, I'm sure, these policies are a little more service intensive. They're service intensive because you have multiple policies doing different things and backing each other. And so I would just say, to add on to Anthony's point, you really need to work with somebody and partner with somebody that understands these very well and is very, and has done these before and understands them, has a good reputation with the carrier, and can get things done like Frank and Ben. So,
man, you guys are just we didn't talk about this in the pre the rehearsal. Thanks for making us look good. No, hey, any questions from anyone who's on the meeting here on just kind of the general structure, the types of insurance, any of that stuff before we move into case studies? And case studies may cause some stuff to bubble up too, but just pause here for a second. Any questions from our esteemed peanut gallery? And you're always welcome just to chat, type something in the chat too. Kristen on our team is monitoring that in real time, and she'll just interrupt us if she sees something. So, all right, case study number one. I think this is the simplest one to understand because it's probably gonna be the most commonplace for all of you on the call. This is where we've got an existing life insurance policy that's been placed. It could be a recent placement. It could be one that's been around for 10 or 20 or longer years. And this is a fact pattern, a WealthPoint fact pattern of a client of ours that we worked through this whole process. But we thought it was instructive to kind of understand, again, how does this work and why would a client do this? So quick current situation to set it up. Jim and Debbie have a net worth of $100 million, and they've done a lot of estate planning. All right, they've used their exemption, they've sold stuff to trust, they've done all the gifting. And despite all that, they still have a estate tax liability or proposed estate tax liability. And so they needed to buy insurance. They bought insurance from us 4 or 5 years ago. And they bought this $25 million Hancock second to die policy with an annual premium of $200,000. And this is supposed to satisfy the liquidity need for the trust upon death, whenever that may occur, right? This is a very common situation. And so we basically went to them and said, hey, did you know that you can basically add, again, a PPLI account underneath this existing planning that you've already done, and you're not going to disrupt the planning at all. You're going to keep the 25 million, but we're going to be able to shelter roughly $14 million of your investments inside the trust from the erosion of ongoing income, capital gains, and then ultimately step up in basis tax at death. So the after-tax investments in the trust were around $63 million. We isolated about 14 million of that for this case study. And what you're going to see is when you do repurposed PPLI, the premium that you can stuff in is a kind of a reverse solve. We take the existing policy to the carrier. They say, hey, here's what it looks like on a MEC and a non-MEC basis. Does the client want access to the cash throughout their lifetime or not? And here's how much money you can stuff into this new PPLI policy, given those facts and circumstances. So for this particular case, the age, the underwriting classification, all that fun stuff of the host policy, we were able to, again, park about $14 million roughly inside this newly created PPLI policy. So the results that we're going to show you at the end use a 7.5% average annual return, a 30% roughly annual tax track. So the cost of the tax is going to be about 2.3%. So when you see the outperformance, that's what you can kind of know how we backed into that. And then just for everybody on the call, your edification at the end of the presentation, all the way in the appendix, you can see this when we email it to you. There's all the kind of proof of work, like, you know, tax rate assumptions, growth assumptions, all that fun stuff. So you'll be able to see that when we email this to you. So how does this work in reality? Step one, we're going to collaterally assign the existing John Hancock policy to one of these two PPLI carriers on the call. And again, they're going to instantly or simultaneously issue us a brand new PPLI policy for the amount of my death benefit I just gave them. And then say, oh, by the way, now you can put this PPLI premium inside this brand new policy of $13.8 million. All right. Step two, the trust then says, hey, I'd like to make that contribution of premiums to this PPLI policy, because now inside the policy, this 13.8 million isn't subject to income tax or capital gains tax. So they make that single premium of $13.8 million to fund that PPLI policy. All right. And at the end of the year, or end of the day, however you want to think about it, at the end of the day, once they funded that policy, they have a $25 million death benefit plus that $13.8 million. So right at quick math is what, $38 million of death benefit at the end of the first year. All right. Any questions thus far? All right. And then ongoing. So it's pretty simple when you break it down. We assign the policy, we then pay the PPLI premium, and then ongoing, what's happening? The trust is still responsible for those annual premiums to Hancock, right? They want and need to maintain that $25 million of coverage. So they're going to keep writing that check, which they were going to do whether or not we did this transaction either way, right? And then ongoing, PPLI carriers providing that $25 million of death benefit plus the cash value, whatever that grows to over the client's lifetime, back to the trust. And so fundamentally, what does that mean from a outperformance on a net to heirs basis? What's the impact of the client doing this? So on the very top line up here, this is the taxable account. This is the status quo. If they did nothing, this $13.8 million of taxable investments inside the trust would grow over the client's lifetime to about $76 million. And on a net to heirs basis, because we're including this $25 million death benefit, we're going to, the two combined assets, 13.8 plus a $25 million death benefit, are going to produce a total value of $95 million to the client and via their trust. All right. The reason this math isn't perfect between 76 and 95 is there's an embedded long-term capital gains tax that's due on death, because these are trust-owned assets and they don't get to step up, right? So really the account balance is slightly higher than the real net to heirs value because of the lack of step up in the trust. But this is a good result, by the way. I mean, the client, and this is what the client is going to do unless we step in and say, hey, there's a better way. So 25 million plus 13 million gives their kids $95 million. Great outcome. But again, what we said about PPLI all along is there's a better way. There's a way to, again, give more to kids, give more to charity, whatever it may be. And so that's this bottom line here. If we repurpose the existing insurance policy and tuck that $13.8 million into this new PPLI account, we save them nearly $21 million in taxes. The $7 million is the cost of the new policy, but the cost of the tax was 28. And this $21 million functionally compounds over their lifetime because it's earning interest, right? It's earning, market returns. And so we're able to increase the account balance by nearly $60 million and a total net to heirs value of over $66 million. So again, from a simple form and a transaction where we repurpose the insurance, we're able to create, another 60% of asset value back to the client's family and for the causes and things that they actually care about. Frank, any comments on this presentation? Yeah.
Sure. I don't know if anybody's wondering this question, but this is really for Travis and Anthony. typically, and Anthony, you had mentioned this early, right? The basic design for PPLI, right? We want to put as much cash in, have a minimum death benefit, and really let that investment grow. If we're working with pre-existing traditional policies and you either using Catalyst or PMC, can we reduce the death benefit on the traditional side so long as we maintain the appropriate amount of net amount at risk, which ultimately will, if someone's still paying premiums, will reduce their, out-of-pocket costs in the future with respect to the traditional insurance? Can that be done in both programs?
Yeah, absolutely. So the interesting one about the case study that that Ben will review is it was a newly issued contract. So in that particular one, he had actually scheduled face amount, after the 7-pay test and other various times to do exactly that, right? The goal is for us is to always maximize the IRR column. When we take a look at a PPLI transaction, that is what we look for, is efficiency, right? Just in the overall product itself. Being institutionally priced, it inherently is more efficient than most that you can get, in the retail space. But obviously lowering that COI just increases that opportunity to do so. So always looking to do that. If there is a flexible face amount on the underlying retail policy, we would absolutely take a look at doing that to increase the efficiency.
Frank, I don't know why you're asking that question. We can do it because you've done it like 3 times. So,
we're just getting the good conversation going, Travis.
I appreciate the plug. Yeah, so we can drop the face, and I think that and I think you might get into this later, but I think there's also some benefit there, right? Because some of the cases that we've done, I'll speak to one specifically, but I'll leave the name out, where we're starting at a high host policy death benefit, but then at some point we can reduce the host death benefit, I think we reduced it from 60 to 25 million, which lowers the cost on the host policy. So again, we're limiting the cost drag for the client there. And then we just we can lower the Catalyst policy down to 25 million. So net, we're just further reducing their overall cost of insurance drag, because the private placement's now offsetting any death benefit they need, plus they have the cash, but all we're doing is reducing cost, which is always good in any of these structures. So yeah.
Okay.
Yeah, I would say these are as customizable as you want them to be, right? Always shooting for planning objectives of the family group that we're working with, right? So the next page, and we'll get to the second case study here that Frank will lead us through, this is just the year by year. On the left-hand side right here is status quo. This is the taxable account, the $13.8 million that's growing by 7.5%. The tax that's being assessed on it. Again, grantor or non-grantor trust doesn't matter to us. Again, the tax is going to be due on these assets each and every year. And that's functionally what we're doing here, right? We're trading the cost of the insurance for the cost of the tax. So the net to heirs calculation is the amount of the investment plus any growth plus the death benefit at the end of the year. And you see the net to heirs growing there. Over here on this side, again, the $13.8 million goes into the Catalyst or PMC policy. There's the growth here. The cost, again, this is the M&E fee that's assessed by one or either carrier, again, depending on which one we go with. But ultimately, this is what we're after, right? What's the value? What's the net to heirs value? You can see right out of the gate, year one, day one, we're ahead $200,000. And again, that just continues to compound year over year as the clients go. And again, like all PPLI policies, this is kind of an aha for us, but maybe for some of you on the call too. Unlike regular life insurance, right? The longer you live, the lower the IRR gets, right? The longer you live with a Catalyst or PMC or traditional PPLI policy, the longer you live, the better it gets. So we actually want these clients to live a long time, because again, the outperformance of what they otherwise would have done only inures to the benefit of the trust and the planning that they really wanted to do. So that's a wrap for the first case study. Again, I think there's a lot of these out here for my trust and estates attorneys on the call. All the planning you've done, I'm sure it's buttoned up. I'm sure it's tight. The clients love it. The good news is you don't have to disrupt what you've already done. You just get to add a little cherry on top, so to speak, and deliver additional value back to the family group. So, Frank, I'll let you take it away on this one. This is your case.
Yep. You can go to the next page.
No,
please. Yep. So in this is an existing case that I am working on. Mr. Smith is 77 years old. So we just had a question in the chat about does this make sense for an 80-year-old? So this is not a pre-existing policy, but my answer to the question, and Travis also responded in the chat that yes, this will work for 80-year-olds. The time of deferral is going to obviously be shortened, but it definitely works. In this particular case, Mr. Smith's going to have an approximate estate tax liquidity obligation of over $300 million. We were engaged by the estate planning attorney to try to come up with a tax advantage liquidity solution. So one was, we had several goals and objectives here, right? One was to provide liquidity at death in the most tax advantage manner. Echoing Ben's point, which he just made, was design a strategy which improves the longer the client lives past life expectancy. And while this client has a family office, I think this last point goes to all of our partners that are wealth advisors that are on the call, is they wanted to maintain control of the underlying investment to the greatest extent possible, right? That doesn't mean violation of investor control rules, but it did mean not wanting to turn their money over to the general account of the insurance company. So the challenges here were, although the client he's 77, he believes that he's going to live to 110. He balked at the initial costs of the traditional insurance. And again, the returns of the traditional insurance are degrading over time, right? So let's go to the next page. So we went through a bunch of designs. So initially, this was the ultimate design that we ended up with, but on the traditional side. But we also looked at MEC, non-MEC contracts. How could we potentially drive this into corridor? And so really the only way we could create a traditional contract that satisfied the client's, at least the expectations of his own mortality, was essentially to have on the $50 million death benefit, dump approximately $40 million into the general account of an insurance company and hope that we got that performance from the general account or whatever it was tied to, whether it was an index or just a UL crediting rate. Ultimately, what we did was we designed here's a traditional policy. It's going to cost $2.2 million a year to maintain a $50 million death benefit to age 110. And as I initially said, the client was not particularly excited about that. And so in talking to my very smart partner, Ben, we actually devised a different strategy that we went back to the family office with. So in this particular case, we're comparing the taxable account on the left side versus a Catalyst or PMC program on the right side. On the left side, we have a $40 million initial investment, and we're accounting for the insurance costs on the traditional side. So that's that 2.2 annual deposit. And so we assumed on the taxable account that they were going to take a slice of their investable assets and put it into private credit. And as we know, private credit, people may love the asset class, but from a tax perspective, it's just getting hit with ordinary income taxes year after year. And by the way, this client is a Texas resident. And so we see on the left side, there it is. That's what the private credit is performing. And even though it's a 9% gross rate of return, at the end of the day, the net to heirs is 5.33%. We said, you know what? We need that liquidity from the traditional insurance. How can we provide both the liquidity need as well as the investment posture that the family office wants to take? So we devised this program, obviously combining it into a Catalyst PMC piece, where We're going to put the same amount of money into the private credit fund, and we are going to maintain a $50 million death benefit through the life of the contract. Now, as we talked about before, this could change, but for the foreseeable future, that extra $50 million of liquidity was going to go a long way. And because of the age of the client, if we try to recreate this maintenance of $50 million net amount at risk, ultimately that would really lead to a degradation of performance within the PPLI contract itself. And so the better solution was to say, listen, we are going to use the tax savings. So if you look back on the left side, that annual tax column, which again, all of the math is in the appendix, which we're going to send to everybody. But we have got annual tax savings, annual taxes, assuming a taxable account, beginning at $1.5 million and growing, into almost $10 million around age 100. So by placing the private credit investment inside the PPLI wrapper, we are saving that annual tax bill and repurposing a portion of those funds to maintain the $50 million of traditional life insurance. And as you see, when we go to the far right-hand column on the PPLI Advantage net to heirs, not only are we maintaining at least a $40 million plus advantage in all years, but as the client is getting older, the policy performance is improving. So this is in this particular case, again, just a summation, we are using the annual tax savings to help really mentally pay for, and more so for the cost of the traditional insurance, to provide a far superior result to the client's family. So here's just a summary. Again, net to heirs, we're seeing, on net to heirs of life expectancy, we're seeing almost a $47 million benefit. At age 95, almost a $58 million benefit. And then at age 100, it's an $88 million benefit to simply using the taxable account alone.
Yeah, I like how you framed that, Frank, just basically helping reframe the client's perception of saying, hey, we know the insurance is going to cost a lot of money, 2.2 million a year, but what if we just use the tax savings to pay for that cost? You need it, you just don't want to pay it, but you're basically using found dollars, so to speak, to create the liquidity the client actually needs.
That's exactly right. And again, in an investment that the client wants, that underlying investment, right? So you're making the family office happy, you're making the client happy, and it's a tremendous benefit to the ultimate heirs.
Hey, Travis and Anthony, what percent, I know the first case is existing insurance, been on the books for a while, whatever. What percent, if you know it offhand, or you can ballpark it, of the repurposed, PPLI policies are new issue? And by new issue, I mean in the first couple of years. Is it 10%? Is it less than that?
Yeah, I would say 10 to 15% is a fair figure, with it being new. Usually it's going to be capacity issues, right? Or underwriting anomaly. That's usually going to be the two that stand out, that we would need to use it up front, and it's not something already in force.
I would say it's a lot lower with us. I would say it's probably less than 5%.
Yeah.
But I would say in the last 12 to 18 months, we're seeing it a lot more.
Yeah.
So we're seeing a lot more new issue policies. So that's something that's that's happening more and more.
Yeah. Yeah. I know it's been an aha moment for us as we have these estate planning conversations, again, at the high end of the market, where clients balk. Rightfully so. 2.2 million in premium a year, even for a very wealthy, family group, is a lot of money. And if we can help them, again, change or shift their perception of where that money's coming from, again, it might make a sale that is needed, right, for liquidity, might make that more palatable if we can help them find those dollars. Frank, anything else on this case study?
No, I think that's it.
Awesome.
Yeah.
We got one more, and this is just kind of it's super simple, super easy, and then we'll open up for questions here at the end. But as Anthony just mentioned, this is an underwriting outlier, and what we mean by that is, you've got kind of all the carriers seeing a particular risk a certain way, but then someone kind of comes out of left field and says, "Oh, hey, I'll give them a better offer." And so, interestingly, even when we're doing this client, Mr. Tom Scott, I love Johnny's just making up random names, but anyway, so Tom wanted to buy PPLI. He went into underwriting with the idea of buying just traditional PPLI. That's what we wanted to sell him. Honestly, it's the easiest thing to do, right? I think we were doing maybe 15 million, maybe 10, $15 million, something like that, a premium. But Tom enjoys a cigar a couple times a week, as it turns out. And so as we send him out to underwriting, all the carriers rightfully come back and say, "Hey, you're actually a tobacco user." And interestingly, a preferred tobacco with Investors Preferred or Penn Mutual or whatever, in PPLI world, that's actually not a non-starter. In other words, the cost of insurance isn't so high that you wouldn't do PPLI. It's more expensive than you'd want it to be, but it's still way better. It's still less than the cost of paying tax. So we actually could have run with the preferred tobacco that IPL gave this particular client. But interestingly, because we shop multiple carriers in all of our cases, because sometimes, again, you get these outliers, Pacific Life came in and said, "We'll give him preferred plus non-smoker," which we kind of had us scratching our heads, and we went back and forth, and we were like, "Hey, you're aware of the cigar usage, and we're not pulling a fast one on you or whatever." And they said, "Yeah, we're good with it." The problem, though, is Pac Life doesn't offer a PPLI product that we can sell. They actually offer one, but they only offer it through a different channel. We're not authorized to sell their product. So the only way for us to access this, preferred plus non-smoker, so this very cheap insurance, wrapper, was to buy a retail product and then assign it to IPL. And this is actually an IPL case, but this is the one where we bought the policy, assigned it to IPL, and they created the Catalyst policy not the PMC policy for us. And so interestingly, you can kind of see the IRS here, the outperformance, all that. I won't belabor this. You guys have seen this. This is a very standard. Hey, how much better is it to do this than the other? But again, the idea here is that when we go out to market, even if it's a PPLI only sale, we're still going to shop all the carriers just in case we get a better underwriting offer for our clients than we would get anywhere else. Another case that we did actually with Travis, a very sizable case this last year, was let me see if I have anything else. No, we'll get to here. Was a client who was a decline across the board. So when we sent him out, wanted traditional PPLI, Prudential declined him, Lombard at the time declined him. We sent him out to the retail marketplaces nationwide, Hancock, everybody declined him. But again, this isn't a Pac Life commercial, but for some reason they came in and said, "We'll give him a table 4 offer." Table 4 is 4 notches below a standard rating. And again, normally in regular insurance planning, a substandard offer would probably price yourself out of the market. Again, going back to the cost of the insurance and all that. But again, with PPLI and reducing the face later on in life, a table 4 offer actually worked beautifully for us. And we were able to place a very sizable PPLI transaction using a table 4 from Pac Life through our friends and Travis at Lombard. So again, there's lots of creativity around here. We want to kind of give you guys 3 different ways of looking at it: existing insurance, new issue where the guy or gal or family group needs liquidity and they just have sticker shock. And then again, just knowing that there are other outlets to being able to access the market if the primary core carriers that we go to for PPLI don't work. So we're going to stop. I think we have 10 minutes, 7 minutes, whatever left in our allotted hour. But real quick, as we go to Q&A, in a month, we're going to be doing a deep dive on PPVA, so private placement variable annuity, looking at how PPVA can augment charitable planning and other goals and long-term wealth transfer and estate planning goals. So register for that. You can click that now if you want. We'll send out emails. We'll bug you guys on that later. But Travis, Anthony, any final thoughts that I've not covered on this deep dive yet? And then obviously, if you got a question, jump in.
I have one comment real quick. I think Anthony had a great point about 5 minutes ago, and we did not actually cover this in one of our examples, and where Anthony was mentioning capacity in the marketplace.
Yeah.
So that is another really important consideration in terms of looking at a catalyst program or PMC. There are death benefit constraints in the private placement market. And even when they go, whether it's at the carrier in combination with their reinsurers, and sometimes, particularly if you're looking at younger clients in very large families, they may want to put in a larger amount of investment dollars than the capacity of death benefit would allow strictly in the private placement market. And so being able to access the traditional death benefit market and then being able to partner with Travis or Anthony to provide more opportunity for the client, that is another very important aspect to both Catalyst and PMC.
That's right.
Yeah, Frank, you bring up a good point. We always say it's kind of an art, not a science, of trying to stack all these retentions either in the retail space or either with both Travis and our reinsurance companies. So in those opportunities, you kind of have to be careful about how you approach the market, right? Because some of the retail carriers share the very same reinsurance carriers that we do here at IPL and also at Axcelus. So just like you guys would do in kind of stacking capacity from a retail standpoint, we have to do the very same thing here. So it's a very important part of that process.
100%.
Yeah, I think one of the good things that you've done too, Frank and Ben, is when we have these, as you mentioned, these large clients that say, look, I want to put $200 million in PPLI. I always tell people, they ask me what I do. I say, I deal with people who want to give me 50,000 or 500 million, and I can't take either. So when you have these people who want to give you so much premium and really maximize these products, which you guys have done a good job at, and people should keep in mind is you go out and you max out the PPLI with multiple carriers, right? You get the traditional PPLI, you eat up all that capacity. And then what you've done is very intelligently is gone out and then picked up just the retention in every little carrier that you can find, maximize that. And then you turn around and you do this repurpose with us or IPL or with both. And then you can really just fully maximize how much money goes into private placement. So kudos to you on that.
Well, look, those cases don't come around very often, but they're fun to work on when they do. So, any other questions? It's been a quiet group, which I understand. Being on a 40-person Zoom is, not everybody's cup of tea. Look, if you have any questions, reach out to Frank or me or Travis or Anthony. You don't have to come to us. All of our contact information is on the next page. And all the appendix stuff back here, like we talked about, is back here for your reading enjoyment later. But look, if this is spurred in your mind, a client fact pattern that you'd like to discuss with us, Chris, I saw you typed in a message about potentially something for you. Just reach out and call us. We'd love to chat with you about it. As you guys know, we're no hard sells on this stuff. We want this to be a team effort with all parties involved to make sure we get the right outcome for the client, and we will work with you to do that. So as we wrap it up here, I guess let's see anything else in the chat. Nope. I'll say thanks to Travis and Anthony. Appreciate
thanks, guys,
your partnership and for being willing to carve an hour out to educate us and the rest of our advisors on how this works. And we appreciate you guys doing that.
Happy to do it.
Thanks so much.
Guys.
Thanks everybody for attending.
Thank you.
Thanks, Ron. We'll see you guys.
Bye-bye.